So for those who I haven't met before, hello. I've been involved in around about just over 550 property transactions, mostly purchases in the past, what is now 12 odd years. And I owe Mark a big debt of gratitude actually, because it was at Mark's meeting where I first ignored a lot of the rules in networking and spent most of the meeting talking to Sue Sims, who I then went on to found Partners in Property with, which is an event that is still running, and we'll have our 6th birthday this year. So I know Mark's got a few months on us. So I owe him a debt of gratitude for that. So thank you, Mark. Yeah, that's right. Yeah, we are in the same venue. That's right. Yeah. So most of those properties that I've bought, I've held on to. That was my goal, to build a big portfolio. And to hold on to it and hopefully to extract a reasonable amount of value from it. I wanted to do it in the most boring of all ways, buy to let, original, vanilla, really, really reliable, because what I saw was lots and lots of risks out there in the broader environment, and my background was in financial services, and also I ran a betting syndicate. Now you might think that sounds ridiculous, but actually there's not a huge amount of difference between those two things, if I'm honest with you, because what it really, my favourite quote of all is that I'll get this wrong now, but the gambling known as business looks with austere disfavour at the business known as gambling, and that's and really the point behind all that is it's all about risk management. It's all about risk management. So whilst I say I ran a betting syndicate, what I did was I told people what to bet on and I hedged those bets. So that actually we couldn't lose money. We only ever had upside. We didn't have downside. So that's probably not what most people think of when you think about bookmaking and gambling. In fact, it was really trading and arbitrage trading. And that's what I sort of took forward into property. So go all the way back to 2011, financial crisis had happened. I had one property at the time where I'd made all the mistakes you can make in property, bought it with the wrong partner, brand new, top of the market, part exchanged her house into that house. The house builder wasn't bad, to be fair. Could have been worse, could have been one of the worst house builders. But apart from that, every mistake you could make. We bought that house in 2006, parted company in 2008. Luckily, we had a tracker mortgage, which has meant actually as a rental, that house has made quite a lot of money over the years until the last few months, where the mortgage rate has gone from £100 a month to now £819 a month. Now, luckily, it's in Solihull and it still cash flows at the moment, but it needs a pretty dramatic repricing or else I need to get rid of it. But that tells you a lot about property, because apart from the pure fluke of having a base rate tracker mortgage, couldn't really have cocked it up anymore, realistically. And still, all I need to do was stay in the game for long enough and manage the asset reasonably appropriately, and it's made quite a lot of money. And that's primarily because, apart from anything else, when you buy property and you use leverage, you borrow from the bank and you try, normally, or you're forced to, really, that's been the way it's been over the last 13 or 14 years, you're forced to take a fixed rate mortgage. You can get variable rates if you want to, but generally speaking, you've pretty much been priced into getting a fixed rate mortgage. And that fixed rate mortgage has been at a very low rate, thanks to what happened in 2008. So I saw this opportunity in 2011 and I thought, right, prices have come down, rents are strong, interest rates are low, these houses can actually cash flow, whereas people might forget this, but before pre-08, not so much around Birmingham, but certainly when you went into the southeast of the country, people would put money in every month to property, like a pension, like a traditional sort of pension, because they were just speculating on the value of the asset going up and up. And of course, it was going up and up before the wobble. And then in London and the southeast, it continued to go up and up. We had to wait a little bit longer, but happily, since about 2016, we've dramatically outperformed, particularly London and a lot of the southeast in the Midlands and surrounding areas. So I decided, I think plans need to be as simple as possible at a high level, and then you can get down into the detail. So my plan was borrow as much as I could at the lowest rates that I could, buy as many houses as I could, and put as many tenants in there as I could, and fix those mortgages, not in one block, but so that every week or every month, depending on how many properties I got to, there would be a mortgage rate dropping off. So this was part of my financial services background. I understood the risk that you were taking. If you have a portfolio of 100 properties, or it doesn't matter if it's 100, it could be 10, or it could be 1. If you've got 1, then you've got that risk anyway, automatically. But if you've got 10 and you have 1 portfolio loan, what happens if the bank changes their mind on lending to people? One of my business partners has been in nearly 50 years in property. The only thing that ever scared him was in 2010 when HSB said to him, sorry, but your facility isn't something that we want anymore. And it's not personal. We don't want any UK buy-to-let exposure. You've got 3 months. 3 months to move. And he had 3 months, and at the time there were only really 2 lenders in town, Lloyds, and Handelsbanken. And he actually moved his whole portfolio to Handelsbanken. It cost him 30 grand and a lot of sleepless nights. Now, luckily, he had quite a low loan to value, and he had the 30 grand to spend on the revaluations. And if you've ever worked with Handelsbanken, getting to move within 3 months, you'll know, is a hell of an achievement. Especially in 2010, when they were one of the only 2 real games in town. And as I say, HSBC pulled the trigger on everybody's buy-to-let lending facilities. So what did that teach me? And it's one of those happy mistakes, or not, mistake might be a bit harsh, but one of those things that you can learn from other people doing that you don't have to go through yourself. So number 1, don't have only 1 lender. So I have a rule, no more than 20% of my exposure with 1 lender. That's an important one. Number 2, don't have all your financing dropping off at the same time. So when I saw what was starting to happen last year, so I'll do a very quick whistle-stop tour because I spend a lot of time and effort. I write a piece on Sunday mornings that we publish on the Partners in Property website, and also I publish on my LinkedIn that is about the macroeconomy and then what it means for property. I call it the Sunday Supplement, unashamed theft of the Sunday Supplement tag from the papers from many years ago. And I look at what the implications might be of what's going on in the economy for property investors. And what we can all appreciate at the moment is there's actually lots of things outside of our control. And I've always known this since 2011. I was in a room like this in 2015, and someone said, right, what's the top 10? It was the beginning of 2015, January talk, right, what's the top 10 things that property investors need to worry about? And I put my hand up and I said, the interest rate. And quite a lot of people in the room looked at me like I had 2 heads. I'm quite used to that because I'm quite difficult and I say strange things. But nonetheless, my point was not that it was going to go up in 2015, but my point was that's the number 1 thing we need to worry about, because when we get into the detail of whether we do HMO, whether we do SA, whether we do vanilla tenancies, there's lots of bits there that we can largely control. Yes, things go wrong, people go into arrears, things happen to people in their lives, right? But largely speaking, we can control it. And if we've got a portfolio, that risk becomes a small percentage, and you start looking at your arrears as a couple of percent of the rent roll, your voids as a couple of percent, although at the moment voids are pretty rare, to be honest with you, but you know what I mean. So you can manage all of those risks with a bit more exposure and a bit more dilution, right? But you can't manage the interest rate, because no one phones me up and says, what do you think about, what should the Bank of England do next time they have a meeting? Even though I've got quite a strong view on it normally. They don't phone me up and ask me that, and they don't phone any of us up and ask us that, right? So we have to we take that, we're price takers in that situation. What's happened? Well, my base plus 0.49, I think it was, has gone from 0.69% to 4.59%, 4.49%, and it's probably going to go up again when the bank meet next week, the week after next. So that's what we can't control. These are the things that we can't control. So what implications do they have? And by using this methodology and by writing the supplement, which helps me stay on top of these things and remain accountable to the people who spend their time and effort reading it, I noticed last year, I started talking about inflation in early 2021 when there wasn't a lot of talk about it, but it seemed very inevitable to me. You cannot pump as much stimulus as we did in the UK, and there was much, much more per head pumped in Europe and in the US, but you cannot do that without creating inflation. Now, confidence was super low, money was super, super cheap. We were talking about whether we would have negative rates in the UK at that time. But what had really happened was the government had looked after most people reasonably well when it came to the economy as we went through the pandemic. You know, we lost 25% of our GDP overnight. I was stunned that it wasn't more. Shows you how resilient the economy is and also how many people could already work from home. And that's because we've got a primarily service-based economy. And we bounced back, or at least we rattled along the bottom reasonably well, and we looked in semi-reasonable shape. But inflation was always inevitable, because for those who don't know, what happens, and you know, a lot of it started in commodities. When you operate a lumber mill, you know, you don't make split-second decisions whether you grow a tree that day or turn the saw on that day or whatever. These are made in cycles and seasons and sometimes years. And when everybody saw COVID hit, they thought, right, no one's going to need any oil because they're not travelling. Of course, that was temporarily true, right? But the effect that they didn't understand was, what would it look like in 3 months, 6 months? And people couldn't forecast it because they'd never dealt with a pandemic before. And that's what makes things so difficult. So early in 2022, I was banging the drum saying, break your fixed rate mortgages that you've got. We were personally broke ours out to June 2024, right? Because I was so convinced that the interest rate was going to have to go up so much. And the writing was already on the wall. The rates were rising. The bond yields were rising. So a lot of people get confused between the Bank of England base rate and then how mortgages are actually priced. Now, mortgages are priced based on 5-year UK government bonds, effectively. It is a bit more complex than that, but that's the number you need to think of. And the 5-year government bond last year had gone up 250% reasonably quickly, 250 basis points reasonably quickly. Now, it's quite simple to understand. The money costs this much. Now, in 2021, the money cost this much. Nearly nothing at all. Now, the banks, being the banks, are sticky in these situations. So they don't put the price down as far as they could, but they did still put the price down quite a lot. I'm holding a few 5-year fixes that were approved in 2021 at 2.84% in a limited company. So I would say that's around about, there might be a few people who beat me, and if you did, then well done. But just because we do so many, that's about as low as it got, 2.84. If we fast forward to October last year, we were seeing quotes at 6.5 and 7 and beyond, and we're extremely concerned. Now, again, there was a significant wobble for an obvious reason, which actually might end up being a really helpful thing, bizarrely enough. And that's often the way with the economy, even with someone who really didn't have a bloody clue what they were doing in charge, the economy somehow is resilient and it still survives. So what happened was, it knocked the froth off the top of the market. We were heading towards, we'd had a 25+% increase in house prices, right, 30% plus in some areas, and was anybody particularly successful in buying property in 2021? Anyone brave enough to put their hand up? Because
we bought a few.
And were you happy with what you got? And were they the same sort of, did you manage to use the same sort of methods that you'd always used?
Yeah, there was stuff we've been working on for a few years, and they just come off during the lockdown because the people were, and
right,
got like 10-year mortgages on them as well, so that was even better.
Fabulous. So that is exactly, at the end of 2020, a very similar thing happened to us. We bought more property in 2020 than we'd ever bought, but it wasn't because of the work that we've been able to do in 2020, it was the pipeline that we keep. One of those we've been working on for 18 months. One of them did come up because of COVID, and it was a particularly, better off than they were 30 years ago. Unique opportunity, which we were able to take the plunge on. But in terms of volume-wise, we did about 100 transactions in 2019, and the number of actual transactions dropped dramatically. There was just a couple that were in portfolios of properties and things like that. So it was much harder. And most people were reporting back. And I have, as part of my group of companies, an auction buying company. So we buy professionally at auction. It's quite rare. Most of the auction professionals you will meet are actually traders. They buy and sell stuff. They buy stuff from outside of the auction and they flip it through the auction, or they buy from one auction and they sell in another auction. Difficult, risky game, but risks can be managed. You really need to know what you're doing. We are not like that. We just try and buy sensibly and intelligently from auction. Right? In 2020, I had to furlough the people in that business, and they were on furlough for 18 months because the auctions were so crazy that we couldn't find stuff that was easy enough to transact, that worked, where the numbers worked. And I saw things running away, and you start to get worried about bubbles, right? Now, bubbles have been going on for ever since there's been a market. You can go back hundreds of years and study bubbles, right? And the funny thing is about them, they're usually pretty much the same sort of thing. So this is the sort of thing that it's happened at least twice in the crypto market since cryptocurrency has been a thing. It's not to disparage that cryptocurrency will never be useful. It's not to disparage the blockchain. It doesn't matter if we were buying and selling tulips, which is what it was in the 1600s, right? It's just an opportunity to have a bubble. And it's also an opportunity to get people to put money into things that they don't understand. And as soon as your logic, I call it castles in the sky, as soon as your logic is, buy it today because it'll be worth more tomorrow, right? That's where the problems start, because that is not fundamentally an investment strategy. And believe me, I would expect I've probably gambled more money than everybody in this room put together. In fact, I'd be highly surprised if I haven't. But that's real gambling. That's not investment, that's real gambling. So that's where you need to be cautious. But we hit this election of Liz Truss, who wanted to take her economic lead from the Bank of Japan. If anybody knows anything about Japanese economics, they've had what they called the lost decade, which was the 1990s. The problem for them is it carried on into the 2000s and then the 2010s. They've lost about 3 decades of economic growth. They are no better off than they were 30 years ago. And that didn't seem to me like a very good plan, to be honest, to follow. That sounded a bit rubbish. So I was extremely concerned. But of course, politics works in that way. Her star was on the rise. For whatever reason it happened. And then to my dismay, she then proceeded to act out and get her chancellor to act out exactly what she said she was going to do, which is surprising for a politician and also disappointing in the case of Liz Truss. But what it did was it sent markets into a panic. It sent the bond yields flying upwards. So the price of debt went up and up and up and up and up, because what people are effectively saying is, if you're going to go around doing unfunded budgets, and it wasn't really about whether it was a tax cut or whether it was this or whether it was that. The point was, we have an organisation in the UK that is set up that's independent from the government called the Office for Budgetary Responsibility. Very boringly named, but the clue is in the title. They are there, so there are responsible budgets. They said, no, we don't worry about your numbers. We're just going to crack on, 3 weeks into the job and just do what we think is right. And rightly or wrongly, if you were an international person or institution who lends money to the UK government, you'd be a little bit worried by that. So they were worried, and they speak by saying, right, we're going to sell the bonds that we've got. That drives the yields upwards. Now, what happens in these situations is then sometimes you get to a little trigger point, because bonds are not built to be particularly volatile instruments. They're supposed to be even more boring than buy-to-let property. They're supposed to be dead safe. They're supposed to be, governments never go bust and never default. I mean, they absolutely do, and every major government has defaulted. And if you ever hear the US government hasn't defaulted, that's a lie. They've all defaulted at points in the past, and they can do. But it's very, very rare. And of course, when you control the central bank and you control the printing press, then you shouldn't really go bust, because if you need more money, you just print it, realistically. Although that can be inflationary. You might see the circularity in that argument there. So what happened was, a lot of pension funds were holding a big amount of gilts, and these gilts were valued based on when the yields were particularly low. So if you can't imagine anything more boring than running a pension fund. You've got all these people, you know how old they are, you've got a rough idea of when they're going to die because you know all the actuarial figures, and while they're alive, you need to pay them money. And when they're dead, you don't need to pay them money anymore. That's the whole job, right? Now, the problem is, you haven't got enough money because there's never enough money in the tank, and people start living longer, and medicine moves on, and all the rest of those things. So you need to take a few risks in order to get the returns that you need to pay the pensions, and you've got to pay them every month, right? So they had all these what are called, there's a strategy within pensions called liability-driven investment. So what they're saying is, I know I need to pay 50 million next month, so I need to have investments that will yield me at least 50 million, otherwise I've got a negative cash flow situation. Now what some clever bright spark did, as they do in the city, said, aha, but what you could do is you could buy bonds in order that you can pay these pensions, but you could also borrow against those bonds. And maybe you could buy some more bonds, or maybe you could buy some other stuff. Maybe you could invest in venture capital, which of course a lot of them have done because they've been chasing returns. And this is the weirdness of the situation. If you went back 30 years, right, a pension fund, it was even more boring back then, because where bond rates were at, all you needed to do was buy bonds. You could cover 90% plus of your liabilities by just buying bonds. When the interest rate went down to zero, which it effectively did after the financial crisis, buying bonds didn't work anymore. In fact, it completely stopped working. So pension funds needed to buy equities. Right now they return more money over time, but they're not reliable for getting you your 50 million next month if you need it. They started getting involved in venture capital. They started getting involved in all these even saltier things with higher returns because that's what they needed to do. They needed to gamble effectively. Now, of course, it was much more sensible than I've just made it sound, but it was definitely much more risky and the world was much more risky. And why Liz Truss might have done us a favour is she may well have popped that housing bubble because what happened is people stopped being able to afford investment properties because the numbers just didn't work anymore. People were priced into mortgages they already had, suddenly became a lot more valuable. Now the problem is that can clog up and will clog up the market and will lower the number of transactions that we have. And ultimately, as you can see in the press, it sent house prices going downwards a bit. Now I'd argue, if you can deflate a bubble rather than let it pop, that's a hell of a lot better situation. And this is very pertinent because what happened is that the gilt yields were going up and up and up, and we were starting to look like the UK looked more likely to default than Italy or Greece at one point in early October. Now, if you know anything about the economies of Italy or Greece, that is laughable because they owe much more money, they make much less money, and they've got far bigger entrenched problems that have never been sorted by what happened with the EU in the last decade. And they won't be, quite frankly. So that looked ridiculous. But the Bank of had to step in and say, right, we will do whatever this happens. They always use these magic words in these situations, whatever it takes, because they're trying to instill confidence in people. And money and the financial system is solely built on confidence, right? We will do whatever it takes. So what they started doing, for once, actually really sensibly, is they started buying these very high-yielding government bonds. You were getting over 5% for bonds for the next 30 years. Now that's fairly attractive in a world where you've been used to getting 0.1% or 1%. And that calmed the markets down. And they said they would spend whatever they needed to, hundreds of billions if that was needed. They actually needed to spend a few billion, which is unfortunate because for once they actually made some money on these trades and have sold some of these long-dated gilts back into the system since and banked, I think, a £4 billion profit, which is going into Mr. Hunt's coffers for the budget this week, which he'll be very pleased about, but probably not spending, knowing Mr. Hunt. Not that that's necessarily a bad thing at the moment, right? It's a sad day when Jeremy Hunt becomes your hero rather than an utter villain, isn't it? A very sad day. But that's where we got to, and that's where everything wobbled. Now, what we saw on the streets was mortgage rates have gone up so much. I've got people calling me up, people who I work with in consulting roles saying, well, it doesn't work anymore. What are we going to do? I said, well, okay, hold on a second. Number one, have you done what I've said to do over the last 6 to 9 months and refix a lot of your mortgages? Yeah. Okay, great. So is your existing portfolio in any trouble over the next few years? No. Right, well, actually, then you're going to have a massive advantage. Where does the problem start? The problem starts when you're buying new stuff. Because for people who've been used to buying houses at 6 and 7% yields around Birmingham, West Midlands, Black Country, doesn't work anymore. There's no cash flow for vanilla buy-to-let. So what do sensible people do in these situations? Well, they've got a few choices. Sell up, not a bad option if you think about the capital gain that's happened over the last few years. The problem is, same as the pension fund, where are you going to get the money to pay yourself every month? Capital's great, but I've known people put millions of pounds in the bank and then a couple of years later come back and say, oh, I'm spending more than I thought I would. And I haven't got any meaningful income. So it causes you a problem, right? So what do? They do HMO, potentially, because it's a more active asset management strategy, ups your gross yields. Part of the problem with that has been, as the energy prices have gone up, also your cost base has gone up massively. So you've got to make sure you're making actually a decent net margin on it. They use service accommodation because it's more active, or they start using things like lease options because, normally speaking, you want to try and own as much property as you can because it's going up, largely speaking. But having said that, if you're in an environment where the market is going sideways or a little bit downwards, it's actually not an advantage to hold stuff. I go to bed at the moment and I'm poorer in the morning, and I'm not happy about that. Right? That's not the setup. Now, for the last 11 or 12 years, that has not been the case, and I'm very pleased with the way it's gone. And ultimately, I'm not being revalued in real time. Right? I don't wake up in the morning and go, oh, I've lost 20 grand overnight, or whatever the number would be, because it's not relevant. It's only relevant when I come to crystallise some of these gains, and ultimately, I'm being a bit harsh there because if I go back to the 1st of January 2020, I've piled on an awful lot of money in terms of paper money that I haven't necessarily realised because I've benefited from those 25% capital rises, right? But this is pertinent to what's happened in the last few days. So if anybody has followed the financial news over the weekend rather than Gary Lineker, then, although it's difficult to do so, I know, then you would have heard that a bank called Silicon Valley Bank collapsed on Friday in the States. There is a Silicon Valley Bank UK. If you haven't seen the news this morning, HSBC have agreed to buy them, which is usually what happens in these situations. It's pretty much what I said in yesterday's supplement. It's normally the way. These banks don't go pop. The money doesn't just disappear. So that seems to have shored things up in the UK. In the US, they came out, and what were those three words that I said? Whatever it takes. Doesn't matter if it's trillions and trillions, because another bank has collapsed in New York. So you have to remember the US is organised federally, and there are a lot more of these regional banks, whereas we would traditionally have had our building societies, which wouldn't have been involved in particularly salty lending. But what they do, these Silicon Valley banks specifically, as it sounds, specialised in tech. You start a tech startup, you go out to Silicon Valley, you raise $50 million, right? It's costing you $1 million a month to run the company. You're losing that in cash burn. You put the 50 million into SVB and you draw it down as you need it. And there's hundreds and thousands of tech startups raising that sort of level of money, right? Now that's great until you're worried the money's not in the bank, right? And what do? Well, if you remember back 2008 and Northern Rock and all the rest of it, you see the physical queues of people. There have been some memes from America about people that do drive-by banking in the US, which we're not really used to over here, but queues of cars trying to physically withdraw stuff. And that's what's called a bank run. And that's what took down Washington Mutual in 2008, which was the biggest bank failure in history on the back of Lehman Brothers. SVB is the second biggest in history, but then you could argue we've had so much inflation that $200 billion isn't what it used to be. But obviously it's still very concerning. But the bigger concern is the system okay? That's the question everybody's asking. I was getting messages on Friday saying, are you pulling all your money out of the banks, for example? Now, you don't need an old-fashioned bank run and a queue these days. You go onto the website while it's operational, you log in and you move money around. Now, in the US, they have a $250,000 limit that's protected by the federal government, the FDIC. We have our 85k financial services compensation scheme. We also don't have that many banks. But what you saw on Friday was lots and lots of money going to banks like Revolut and Monzo and Starling and Tide and all of those internet-style banks, because people were hedging their bets, thinking, well, if I can't get access to this money, what will happen? Now, what the bank, to their credit, and the government, and I don't give them a lot of credit these days, but I think they deserve a bit of credit for the swiftness in which they acted over all of this, said, this won't be a problem. So we will make sure very, very quickly, if there are any funds frozen, we provide funds to move them around the system. Now, it's the same as the gilts thing from October. What it does is it brings the confidence back, because if everybody's confident, nobody moves it, right? But this speaks to just how fragile the financial system is at any point in time, but particularly at the moment. And also, overall, how fragile confidence is at the moment. There are lots of people sitting there, and there will be rooms and rooms of people betting on things going wrong. There are a number of people who've placed some massive, massive bets on the interest rate going down in the US significantly because of this. Now, normally you say you have to sing it, but I don't think you can sing that one, can you? So it's not going to be any good. This might, on the bright side, impact the way that the central banks are putting the rates up, right? It may calm down a little bit on the back of all of this, because this situation's been created by all of these banks going, oh, well, we've got $200 billion, and we're not going to need all of that because all the depositors won't come in and take it. So why don't we put 100 billion plus of it into bonds? Now, the problem is they put it into bonds when they were yielding about 1.5%, and now those same bonds are yielding 6.5 or 7%. So they've gone down in value. They could replace all of those bonds today, and the payout would be more than 4 times as big on the same capital input. Now, there are other arguments around this. Some of them say, well, it's okay because this number of bonds are going to hold to maturity. So we know we're still getting our capital back. So it doesn't matter. You've got 10 million in my bank, but the 10 million will still be there. It may well be that 4 million of it is represented by government bonds, but it doesn't matter about the price of the bonds. The government will still pay it back. Now, there's arguments either way on that, but there are also bonds that are there to be liquidated, and they've gone down dramatically in value. So what you saw was a bloodbath in the stock markets and all the rest of it. Banks dropping because people were suddenly more aware. Here's one of And that's why the canary in the coal mine analogy has been used. Here's one of the things that we didn't understand. And this is very much the way it goes in these situations. We've never been, you might remember the interest rates are at a 318-year low, I think it was when we started in 2009. And then it was 319 and it was 325. And then it went down a bit again and then it went down again because we had a pandemic, and they were all fresh lows. We've never been at a point of a zero interest rate and then a huge hike like we've recently had to deal with. And the way that the central bank and the government have dealt with this is to say inflation's the biggest danger of all. Now actually, the government is quite keen on inflation because all of their debt is nominal. So the more you get paid, even if you can't afford to do more with it, the more that everybody gets paid, ultimately, if they've borrowed 2 trillion, they still owe 2 trillion. If that 2 trillion only buys 1.5 trillion's worth of stuff, in terms of purchasing power terms, then the government's better off. The tax take will go up and up and up and up and up. And they've hit us all with the hammer by saying they're going to freeze all of that till 2028. So all these thresholds that are frozen are the biggest tax grab pretty much in history, but of course they use a lot of distracting tactics to make sure everybody doesn't understand all of that necessarily. And inflation, I always liken it to like carbon monoxide. You can't see it and it doesn't do things on the day, but it is a silent killer of stuff. Now the good news is, for property, if you've got nominal debt, it's absolutely the other way around, as long as the assets can perform, right? Because all of the tens of millions of pounds worth of debt that I've got is all there deflating away. Now, that works as long as house prices are going up. Inflation is relevant, but house price inflation is much more relevant, right? So all of that debt I had before 2020, house prices up 25%. That might have put my equity up by more than 100% because I'm using a significant amount of leverage. And that's made me a lot of money. And it protects my wealth in real terms, right? Now, if house prices are going downwards, then it doesn't really matter that is going upwards. It might help my tenants a bit if they're on minimum wage and they're about to get a 10.1% rise, or they're pensioners and they're about to get the same sort of rise. It doesn't help me in the trading businesses that I'm involved in, but you give with one hand and you take with the other. And like I said, we've had a good few years, but no one in business sits back and goes, oh, well, we did all right in 2020, 21 and 22, so it doesn't matter if we lose money in 2023. So if stuff doesn't stack up, people don't buy it. If people don't buy it, then what happens when we get 18 or 24 months down the line? And you're seeing this. The house builder stocks have been crushed. The construction sector is predicted to go down by about 8 or 9% this year and another 6 or 7% the year after. Right? There's shrinkage, there's all sorts of other issues. The age of the workers and the amount of skills we've got in the UK is just one of the other issues that we've got. There's a worldwide recruitment shortage because people who did well on the back of the pandemic have withdrawn from the labour market and said, you know what, I'm not going to go to work anymore. 52, don't care, not going to work anymore. Thanks very much, I've got my bit, house is paid off, I'm done. There you go. And there's hundreds of thousands of those people, and this is called the Great Resignation. That causes even more problems. But a tight labour market is not really a bad thing. It's always a thing as it goes, if you go back and look in history, after a pandemic. Now in the old days, that was because everybody died, or lots of people died. And therefore there weren't as many people to work on the farms and all the other things that were going on several hundred years ago, right? It's a bit different now. It's more, right, don't necessarily need to work, so not working. Changed motivations, stopped what I was doing. But coming back to trying to buy new units or trying to control new units, this is why things like options are becoming more popular. The danger of using options is you need to know what mortgage your ultimate landlord is on. If they've got 6 months left on a 3.23% and are happy with what you're paying them, what's their reversion rate? And if they go to 9%, like some of the people I'm buying off at the moment, they're paying over 9% on their mortgages, and of course they've got no cash flow. Even in HMO, you'll find you've got no cash flow if you've got a significant amount of leverage at 9%, realistically. So that's creating opportunities. Now I'm having to structure them in different ways. One of the ways I'm using to structure them effectively is vendor finance or deferred payment, or some now, some later, or whatever you want to call it. So in order to make up for the fact that the bank debt is so much more expensive, I'm having to borrow money back from the vendor at a lower rate so that the entire blended rate that I'm paying over the cost of a whole deal is effectively the same as it was a couple of years ago. Now you can imagine, there's not loads of those out there. Not everybody can afford to wait. Some people are liquidating because they want to. But there's also, you know, the average debt against the UK property is under 25% loan to value. So there's an absolute raft of unencumbered and very low financed properties still out there. And there's still at least as many fed up landlords as there've been over the last few years. And the direction of travel is not changing yet on that. And like typical government policy, they'll only change this when it's too late. We've still got years to come yet of going the wrong way before someone actually steps up and goes, do you know what, we need a new way. And until they realise that, there are going to be problems. There's less than half the amount of stock on the rental market than there was in 2019. So there's over 450,000 houses available generally around the country. There's now around about 200,000. What does that do? Simple supply and demand, fewer properties, higher rents. I'm sure everybody's seeing some of that. Rents take a little bit of time to catch up. I always advocate active asset management, so we put our rents up every year anyway. Historically, it's been at the 2 or 3% level. This year it won't be, it's going to be more at the 7% sort of level. Still below inflation. Hopefully, we've avoided the worst bits of what could have been a really problematic energy crisis because those prices have come down. But again, we're back to things we don't control. We don't control the interest rate. We don't control Russia. We don't control the cost of energy. We don't control the fact that we haven't actually got enough energy to satisfy global demand. And the markets are just not really reflecting that at all at the moment. But coming back to property, if you can still buy it, it's still a good time to fix that debt as long as you've got enough to service that debt. Now, I've historically always tried to get 200% coverage. So if it's £1,000 a month net rent, I want 500 quid or less on the mortgage payment, which is why I'm not doing anywhere near the volume that I was at the moment, being quite selective. But you'll understand I've already got a lot of exposure and I don't really need to add to that necessarily, although I do want to when there are good opportunities. So I've started looking around at other things, buying cash flowing businesses. I have a number of complementary businesses, lots of which are involved in the property sector, but not all of them. Some of them are just asset backed, so they've got a building or a warehouse or whatever that they trade out of, and they're producing cash flow. Because what's happening is, apart from anything else, if one of them is a bakery, right, prices are up 12% this year, it hasn't affected sales. But what it does mean is, the price we pay for the bakery, we're getting 12% more revenue de facto by not doing anything. That's where inflation can be useful. Now, it works to a point. At the moment, everybody's doing it, and this is the spiral that happens, wages and prices. Wages are coming up, which next month is going to put a load more money in lots and lots of people's pockets, and that will keep things going, which will mean the banks still want to raise interest rates to try and cool down the economy. And that's sort of where we're at. But I'd encourage you not to worry too much about where the rate's going to peak, whether it's 4.5 or 4.75 or 4.25. It's more about how long it's going to last, right? And this is likely to last for some time, as in several years. If it doesn't, and we have a major drop in the interest rate, it's because we've had a much bigger crisis than Silicon Valley Bank going bump. And this time, those magic words, whatever it takes, don't work to restore confidence in the system. Now, 2007 and 8 was much worse. The writing was very firmly on the wall in early 2007. It still took 18 months for everything to really play out. So part of the beauty of property is that you get to see what's happening, sleep on it, and make a decision the next day, right, or the next week. You don't have to hurry into things. But what I've been doing primarily is cutting down the amount of debt I've got, and I've done that by selling properties off, right? So I've got less debt, and I only do deals where I can fund them 100% leverage. So I might be buying 75% from the bank and 25% from an investor, and I still want cash flow.